Here's 5 ways to avoid going bankrupt when buying a business. Number one, don't buy in an industry that you don't know. One of the great ways to go bankrupt is to buy in an industry that you don't understand at all. Business ownership is really hard, and going into an industry that you know nothing about, you really don't stand much of a chance. And we see this all the time with people that come to us. They might have 15 years of experience in one industry, and they're like, I want to buy a business in any industry but the one that we know. And we always push them to the one that they know because the shift from employee to owner is so massive that that alone will change their view on the industry. And every industry has its aspects that's hard. So everyone says, no, this is why my industry is bad. Other industries have the same things. It's just you don't know it. So let's stick to the industry that you know. Number two, now Warren Buffett nailed this one. You can't make a good deal with a bad person. If at any point during the deal process, the seller shows that they're not trustworthy, walk away from the deal. Doesn't matter how deep in the process you are, no level of diligence and Q of E can catch outright fraud. And then if somehow you are the victim of fraud, the legal system is not going to save you. No one's going to help you. You are going to have to file for bankruptcy, even though you didn't do anything wrong. You were a victim of someone else's fraud. Number three, underestimating your working capital need. No one has ever gone out of business for having too much cash. You need to err on the side as much as you possibly can of having too much working capital. You, as the new owner, you're going to need a different level of working capital than the previous owner did. Things happen with new owners. Typically, sales can slow down. You're going to have unexpected expenses, maybe things that the seller had deferred maintenance on, or sometimes just inexperienced buyers, they spend money on things that maybe they didn't need to when the seller knew that it wasn't a need, it's a want. And another thing that we notice a lot when we take over companies is that the pace of collections tends to slow. So if you base your working capital need on the previous owner's cash collection cycle, you're going to find that yours is going to be longer at first. And I think some of it's maybe there's just some confusion on the customer side as they're paying new people and they're possibly paying a different bank account if you had an asset sale. So some of there's just honest confusion on their side. And sometimes I think it's customers just take advantage of the transition to try to draw out their payments. So if you can, get your best estimate of how much working capital you need, try to account for an elongated cycle, and add 50% more. Number four, leave yourself some cushion. Just because the bank will do a deal at 1.25 times debt coverage ratio doesn't mean you should do that deal. Now, the amount of space you're going to be able to get on the debt coverage ratio is going to be a function of size. Typically, the bigger the deal, the higher the valuation, the higher the multiple, and that's going to result in lower DSCRs, debt service coverage ratios. But also you have a little bit less risk. So the bigger company has more infrastructure, probably less reliance on the seller than a very small company. You also are going to have likely more customers, so you're less reliant on one individual customer. But on a sub-$1 million deal, you probably want a DSCR 2 or greater. And on a $5 million deal, minimum would be 1.35 to 1.4. Really, ideally, you'd want to be above 1.5. And you really want to make sure that in that DSCR, you're realistic about your CapEx needs. That's how much money the business needs to spend each year to just keep going. That's something that you need to figure out yourself. So in the SDE calculation for seller's discretionary earnings, you add back depreciation, but depreciation is a point where the business spent money. So you need to figure out what that normalized CapEx is and be honest about that when you put it into that DSCR calculation. At the end of the day, banks will always lend you more money than you can handle. Don't always take it. Number five, always buy reps and warranty insurance. The odds of the seller either intentionally or most likely unintentionally making a misrepresentation during the sales process is extremely high. And the only way to protect yourself is to buy insurance against that. Because again, say you have a couple $1 million worth of losses that you can prove because the seller made a purposeful or accidental misrepresentation, you're not going to be able to get that $2 million back. The best case you might see is you can get $1 million back through the legal process because you're always going to settle somewhere in the middle and then you're going to have legal fees. So really you're probably going to be less than $1 million. So you're going to end up with more than $1 million loss. So the best way to mitigate that is to go with the insurance company. because also the insurance company is more likely to pay than the person that you're suing, often when it's very hard to collect through a lawsuit. So always go with the reps and warranty insurance. Now, if you want a partner by your side helping you navigate this, go click the link in our bio and let's buy a business together.